Hello, everybody, and welcome to the Trading with Ashley show. Wow, we have such a busy week ahead with a combination of earnings and then a lot of economic events, key economic events. And I am going to help you with taking you through those and then trying to come up with some plays that might be helpful for you. Now, everything that we are going to go over is going to create volatility. So I wanted to talk a little bit about that. Typically, when you're selling options, they're considered safer plays. Also, when you're buying longer term leaps and skips. But in a choppy market like we have going on right now, I encourage you to consider when you see profit, take profit, even if your trade does not expire for another 3 or 4 weeks. Because with this choppy market up and down, you can more than likely get in and out of plays if you have the luxury of time. And a quick note to those of you that were interested in boot camp, the spots are about 95% full. So if you are interested in one of the last remaining spots, you want to hurry and go ahead and click that link below, book a call, and reserve your spot. First, I want to go over key earnings this week. We have some that are before the market and some that are after the market, and there's a lot. So I am going to focus on the ones that are more widely known and potentially a trade or two that you can take as a result. Monday, before the bell, we have Hut 8, which plays into that crypto play. We also have Plug. After the bell, we have Okta and ASTS. On Tuesday, we have Target, Best Buy, and SEA before the bell. After the bell, CrowdStrike and Ross, among others. Wednesday, Abercrombie and Fitch and Foot Locker before the bell. Then, after the bell, we have Marvel, Zscaler, Victoria's Secret, and Lending Tree. Thursday, before the bell, we have JD.com, Kroger, and Macy's. We have Costco and Gap. Of all the potential earnings plays I reviewed, it looks like one of the best setups I have found is for ticker symbol ABGO. Now remember, they report after the bell on Thursday, but let me show you why this might be a decent setup for a sold put. Now, for starters, when you're trading over earnings, you need to be careful. I like to go really low on my deltas and on my strike price, and I like to go further out to allow for a rebound if the stock does pull down. And if earnings is going to put me the shares, I want to make sure I get them at a fair price. So let's review what would be a fair price for this trade. Currently, it is trading at the bottom of its Bollinger Band, and it is sitting on the 100-day moving average. But I want you to notice a few things. Do you see this red line right here? It is the 200-day moving average. It's still sloping upwards, so we are in a bullish trend. However, it sits at about the 179, 178 mark. But I do notice something else too. Look at this gap right here. This is considered a gap that will typically be filled if we have poor earnings or, we could have great earnings and it decides to tank due to forward guidance. But if there's going to be a gap fill, it will more than likely come down to around this 182 mark to fill this gap right here. So if I am going to do a trade, I want it to be below this 200-day moving average and below this gap fill to be safe. And I am going to go a little bit further out. Now, before we look at the specific trade, let's look at the volatility and let's look at the IV crush that happens after an earnings event with Broadcom. Currently, Broadcom's volatility sits at about 56%, which is really high, and it implies that it could be even higher on Thursday. It typically does rise, like most stocks, the day of the event before it is known. But if we look at the IV crush that takes place on Broadcom after earnings, it is typically around a 19% reduction. Well, as option sellers, that actually works in our favor because we will get more money with a high IV, and then when IV lowers, it will make our trade more profitable, allowing us to get out of the trade early, and it allows us to free up all of that capital being held for other plays. So let's take a look at a potential play that will allow us to have a safer trade, capitalize on this volatility, and potentially get out of it early. For this trade, I want to go a little bit further out past the event. So I am looking at April the 17th. It's the third Friday of the next month. And I have settled in on this 170 strike price. Now, this is well below the 200-day moving average. It's also below that gap fill. And it's offering us a safer delta at 0.18, meaning that this particular strike price only has about an 18% chance at this point that it will actually be breached on our expiration date. But what's really exciting is right here. It's paying $438 for us to put up $17,000 in capital. Well, if you look at this on its face value, the returns are good. They're around 20% annually. But what I'm about to show you, if we are able to get out of this trade early, then the returns balloon to almost 100% annually. Let me show you what I'm talking about. When you pull this up in an option calculator, you can see our current implied volatility is sitting at 56. This could rise even more in the coming days. But if we took this trade, we would get the $432 in credit. But if we experience IV crush like Broadcom has in the past, our implied volatility is going to go down. Now, I want you to watch this. If, after earnings, our implied volatility does go down by that 19%, then we would be sitting at somewhere around the 45% mark. Well, notice what happens to our premiums after that implied volatility goes down. It allows us to keep more of the premium. So let's assume that on March the 12th, Broadcom actually has not moved at all. It's sitting at around where it is now, $200. Maybe it spikes up and then retreats back down, or maybe it goes down and then retreats back up. Look, at this point, we would be able to keep $275 of the $432 we received. Well, this is great because if we take our money and go home at this point, that ends up being close to 100% return annualized. And the reason is we'll be cashing in this trade much sooner than the current expiration date. That allows us to redeploy that capital for a new trade. Let's take a look at what we have going on this week with the economic calendar. Now, there's a lot going on that will more than likely cause the VIX to spike. That's okay, though. I have a trade for you that I think you'll be interested in to take advantage of that movement up and down. Looking at the calendar, Monday at 9:45 a.m. Eastern, we have the U.S. manufacturing PMI. Also, we want to keep an eye on the ISM manufacturing. On Tuesday, in addition to potential Fed speakers, we also have all the drama with the tariffs on Canada and Mexico. Wednesday brings us ADP, non-farm payroll, final services PMI, and ISM services PMI. Thursday, we have unemployment claims. All eyes will be on that at 8:30 a.m. before the market opens. And Friday, we have the U.S. jobs report along with the U.S. unemployment rate. Midday, the fun continues. Fed Chairman Jerome Powell speaks. And then we close out the day with consumer credit. One thing I wanted to show you was the VIX, V-I-X. It's the volatility index. And one thing I have noticed is it does spike at times when the market gets nervous. However, when it retreats, it likes to stay right here at around that $13.50 or $14 mark. Usually when it gets down this low, something happens to cause it to spike back up again. Well, you can actually sell puts on UVXY, and I'm going to show you how that tracks with VIX. Here, you're looking at a side-by-side comparison of VIX and UVXY. Notice when the VIX is at around that 13.5 mark, UVXY comes in at almost around the $19 mark. So we can use this information to go and sell puts on UVXY, knowing that if it gets down close to this price, it's more than likely going to pop back up. With any luck, we'll be assigned those shares and we'll be able to start running the wheel strategy on UVXY. Currently, I am looking on the option chain for UVXY. I'm looking at March the 7th expiration. I am looking at the 1850 strike. It's currently paying a really good premium. We're looking at $17 for putting up $1,850. Now, that's in 1 week. That's already a 47% return. Now, think about the fact that tomorrow, if we see the volatility index go down, then we will get a little bit closer to that 1850 more than likely, we will see closer to around 30 or 40 cents premium for the 1850 strike. That will give us closer to about an 80% return. So this might be a really good trade tomorrow. And if I'm put the shares at 1850, I would look to start to sell calls on it the next time the VIX spikes. I hope you're better prepared for the week ahead. Remember, if you're with me trading with Ashley, there is no trader left behind.